Hello and welcome to this episode of Mic'd Up. I'm Pete Seiler, a member of our business development team here at iCM. And today I'm joined again for the second time by Brent Leadbetter with Research Affiliates. Brent, thank you for being back and talking to us again.
Well, it's an honor. Thanks for having me, Pete. I'm looking
Absolutely.
forward to this again.
Very good. So let's jump right in. I've got kind of a longer question to start out, almost two parts. But at a high level, what opportunities have you and the team at Research Affiliates been able to capitalize on in the emerging market space over the last year or two? And as part of that, what risks do you feel that you guys have been able to really effectively sidestep?
Yeah, I think EM has been a unique asset class in that even going beyond the last couple of years, really the last 4 or 5, it's just been dominated by one country, right? On both the upside and the downside, right? It's
Sure.
it's been all about China. So where our performance has come from, the biggest relative driver far and away has been China. When China was getting more expensive in 2019 through 2020, we had a meaningful underweight to China. Today, now that China has sold off and become quite a bit cheaper as a result, our contrarian strategy is now a little bit overweight to China. So in terms of the drivers, it's been drivers 1, 2, and 3 have been China, China, and China, right? And in terms
Sure.
of the risk that we've sidestepped or risk that we've been able to avoid, it was we were underweight China was when it was expensive. Now it's become cheaper, taking a more aggressive position there.
Great. So given that set of facts, what's your outlook for emerging markets in general going forward? Do you still feel that there's runway for the asset class?
Very much so. Very much so. In fact, if you look at our website, researchaffiliates.com, we have an asset allocation interactive tool where we literally forecast 10-year expectations for asset classes, equities included. And emerging markets is the region for which we have the highest 10-year return forecast, specifically because valuations are so attractive there, right? I started by talking about how we're rebalancing into China because China is cheap. At a broader perspective, EM is the region that looks cheapest to us. Accordingly, it's the region where we have the highest future return expectations. High yields, currencies are cheap relative to the US. Multiples are very attractive, particularly given how expensive the US is, right? On a Schiller
Sure.
Cape basis, emerging markets is trading at less than half the price of the US. So the multiples are very different in EM. And so accordingly, because we're contrarian, right, on a trailing 10-year basis, the US has been the top performing region. On a forward-looking 10-year basis, our expectation is that that's going to flip. EM has been the laggard, specifically because it's been the laggard. That's why we expect it'll be the leader going forward, and vice versa. We expect the U.S. to face modest returns or realize modest returns over the coming decade.
Awesome. And that, it's interesting when you have folks come at things from different perspectives. We also have emerging markets as one of the leaders in our 10-year forward returns expectations. So it's just interesting to hear that you guys come out in the same place. Now, with that said, though, so we've really seen, you did mention it, we've really seen significant strength in the dollar over the last few months or even over the last decade.
Yep.
And do you see potential for this to revert and really create a tailwind for EM going forward?
Definitely. Definitely. And I should note when it comes to mean reversion, whether it's for equity valuations or currencies, these are not short-term signals with a high degree of confidence, right? So the
Sure.
dollar's expensive today. We expect, because it's expensive, we expect it to get cheaper over the coming 5, 10 years. We have no view on what the dollar is going to do next month or next quarter, but you referenced how expensive it is today, right? The dollar's creeping up a little bit closer to the highs that it had in 2022, which were the highest the dollar had been since really around the time of the tech bubble, right? You had to go
Yeah.
back to the first couple of years of this century, 20 years ago, to get back to when the dollar was at similar price that it saw in 2022, and we're creeping up toward that again. So again, as contrarians, we think that sends us a signal that non-dollar exposure probably looks attractive. Again, this is not to say that we know with any degree of certainty whatsoever that emerging markets stocks or emerging market currencies are going to be strong performers next month, next quarter, next 6 months. But if you've got a 5-10 year time horizon, valuations tell you quite a bit, and mean reversion becomes very powerful. So we think their EM companies are very nicely positioned in terms of attractive yield, cheap multiples, and there's very likely going to be a currency tailwind at their back.
Right. Brent, great to have you back now with frequent flyer status. Thank you for joining me today. Great information that you're able to share with our viewers.
Thank you so much, Pete.
And as always, thank you for taking out time to watch this episode of Mic'd Up. If you do have any questions, would like additional information, or have suggestions for future topics, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for joining us.